The year is 1695. Captain Henry Every's ship, the Fancy, appears on the horizon off the coast of Madagascar. In his hold, gold, silver, and precious stones worth over $200 million in today's money. But Every isn't sailing home to England to face the hangman's noose. He's sailing to the Bahamas, where a colonial governor waits with open arms and offshore bank accounts that don't technically exist yet. When authorities finally catch up to Every's treasure, they find something remarkable. The gold has vanished. The silver has disappeared. Even the ship's manifest has been scrubbed clean. What remains is a web of financial instruments, land deeds, and investment partnerships that would make a modern hedge fund manager weep with envy. This is another story where money, power, and history collide, and nothing is ever as simple as it looks. Most people think pirates were simple criminals. Bloodthirsty rogues who buried treasure on deserted islands and lived short, violent lives. The popular image shows them as financial primitives, spending their stolen gold as fast as they could steal it. The truth tells a different story. By the late 17th century, piracy had evolved into something far more sophisticated than armed robbery on the high seas. The most successful pirates weren't just stealing money. They were laundering it, investing it, and moving it through financial networks that spanned 3 continents. They had become the world's first offshore bankers. The system worked like a sophisticated shell game, but instead of cups and balls, pirates used ships, islands, and corrupt colonial officials. The mechanism was elegant in its simplicity. Step 1. Capture the treasure. Pirates targeted merchant vessels carrying gold and silver from the Americas to Europe. But they weren't interested in individual coins. They wanted bulk transfers, the equivalent of modern wire transfers, except these transfers sailed on ships protected by nothing more than a few cannons and desperate prayers. Step 2. Convert the physical treasure into financial instruments. This is where the genius revealed itself. Instead of keeping stolen gold coins that could be traced, successful pirates immediately converted their hauls into promissory notes, bills of exchange, and investment shares. They worked with corrupt merchants who acted as the first money launderers, taking stolen gold and issuing clean paper in return. Step 3. Invest through proxy networks. Pirates established fake identities and shell companies centuries before the term shell company existed. They bought plantations in Jamaica, invested in shipping ventures in Charleston, and purchased real estate in London. The money flowed through so many intermediaries that its criminal origins became impossible to trace. The Bahamas served as the perfect headquarters for these operations. The islands offered something revolutionary: plausible deniability. Colonial governors could claim they were simply encouraging legitimate investment and trade. The fact that the investors happened to be wanted criminals was, officially speaking, unknown to them. Governor Nicholas Trott of the Bahamas perfected this system. He issued clean papers to anyone willing to pay the right fees. A pirate could sail into Nassau Harbor as Blackbeard, the Terror of the Caribbean, and sail out as Mr. Edward Teach, gentleman investor. Trott took a percentage of every transaction, creating the world's first offshore banking fee structure. The pirates even created their own version of modern hedge fund strategies. They diversified their portfolios across multiple asset classes. They hedged their risks by investing in both sides of conflicts. When pirates attacked Spanish treasure ships, they often invested the proceeds in British privateering ventures that attacked French commerce. They were simultaneously funding and profiting from multiple sides of the same economic warfare. Captain Bartholomew Roberts, known as Black Bart, operated what amounted to a private equity firm. He maintained detailed financial records, tracking return on investment for each raid. His crew received shares based on performance metrics. Roberts even offered what we would now recognize as life insurance policies, compensating families of crew members killed in action. The system seemed perfect. Pirates could steal with impunity, launder their profits through legitimate channels, and retire as respectable gentlemen. The colonial governments got their cut. The merchants got their fees. Everyone won. Except the system contained the seeds of its own destruction. The problem was scale. Success bred ambition, and ambition bred carelessness. Pirates began targeting bigger prizes, attacking ships belonging to powerful trading companies with direct connections to European monarchies. When Henry Every captured the Ganges Sawai, a ship belonging to the Mughal Emperor of India, he didn't just steal treasure. He created an international incident. The East India Company faced a crisis. The Mughal Emperor threatened to expel all European traders from India unless the pirates were brought to justice. The company calculated the potential losses, millions in annual trade revenue versus the cost of shutting down a few pirate-friendly governors. The math was simple. The pirates had to go. But the East India Company faced a problem. The pirates had become so financially sophisticated that traditional law enforcement couldn't touch them. You can't hang a man for owning a plantation or investing in a shipping company. The pirates had successfully separated their criminal activities from their financial assets. The company's solution was revolutionary. Instead of chasing individual pirates, they targeted the entire financial infrastructure. They pressured the British government to replace corrupt colonial governors. They flooded Caribbean markets with legitimate investment opportunities, making pirate money less attractive to local merchants. They even created their own intelligence network to track financial flows between islands. Most importantly, they changed the legal framework. New laws made it possible to seize assets based on suspected criminal origins, even without direct proof. The burden of proof shifted. Instead of authorities proving that money was stolen, investors had to prove their money was legitimate. The offshore banking system collapsed almost overnight. Governor Trott found himself recalled to London to face corruption charges. Merchants who had laundered pirate money discovered their own assets frozen. Even pirates who had successfully gone legitimate found themselves under investigation. The pirates had taught the world a valuable lesson about offshore finance. The lesson was so valuable that governments and corporations immediately began implementing their own versions. The names have changed. The behavior hasn't. Modern offshore banking operates on the same principles pirates pioneered 3 centuries ago. Create jurisdictions with minimal oversight. Establish shell companies to obscure beneficial ownership. Move money through multiple intermediaries to break audit trails. Convert illicit gains into legitimate investments. The Cayman Islands serve the same function the Bahamas once served for pirates. Panama offers the same services Nassau provided to Captain Roberts. The mechanics remain identical, just with better technology and more sophisticated legal frameworks. Even the collapse patterns repeat themselves. When international pressure builds, offshore jurisdictions suddenly discover compliance requirements. When powerful interests get hurt, governments find the political will to change laws. The pirates' offshore banking system lasted roughly 30 years before political pressure shut it down. Modern offshore banking centers face similar cycles of tolerance and crackdown. The pirates understood something about money that we're still learning. Wealth isn't just about having money. Wealth is about moving money in ways that serve your interests, while appearing to serve everyone else's interests. They realized that the difference between legitimate finance and criminal enterprise often comes down to nothing more than paperwork and political connections. Get the paperwork right, maintain the right connections, and yesterday's pirate becomes tomorrow's respected investor. The system they created didn't die when the last pirate was hanged. It simply evolved. The treasure ships became wire transfers. The corrupt governors became compliance officers. The shell companies became legal entities with registered addresses and nominal directors. But the fundamental insight remains unchanged. The people who control money don't need to break the rules. They just need to write them. And if you write the rules correctly, you can make sure that the only difference between piracy and finance is the quality of your lawyers.